And welcome back to City Online. You saw the dark clouds hanging over the financial district. Ooh, it's because of these troubling economic times. That's what we're talking about, and getting some advice on your personal finances from Frank Wigington. Let's get back to the phones now, and we want to hear from Colin. Hello, Colin.
Hi.
Hi, what's your question for Frank?
Oh, my question is, I just started some investment in the TD mutual funds.
Okay, great.
The monthly fund, the balance fund, and dividends monthly income fund. Now, should I worry about my investments as to what's going to happen with it? Is it going to go down?
Okay, and these are common funds, balance funds, income funds. You know, most of the mutual fund companies have those types of funds.
Yeah.
What should he be concerned about?
Well, just quickly, Colin, if you're still there, how old are you?
42.
And when are you planning on retiring?
Early as possible.
As early as possible,
No,
right?
no,
Okay.
let's say between 65. I'm not going to be working over at 65.
The funds, Colin, that you're talking about are what I would be classifying as more conservative, a little more asset preservation style. And, you know, anything that's balanced tends to be a mixture of equities and bonds. So the bonds are good in a sense where in bad markets, it protects you on the downside a little bit. Income funds also tend to be, again, very high quality companies and trust units and things like this, things that generate a 6 or 7% rate of return. And during these times, this is a great thing to be doing because when you're generating a 6 or 7% return and you're watching the markets fly up and down and you don't know what's going on, you get to sit there and collect, you know, a 5, 6, 7% rate of return while these things keep going up and down. Preferred shares are another example of that. There's a lot of high-quality preferred shares. TD Bank has a preferred share that you can purchase right now that's got, I think, a 5.6% dividend yield.
So he's doing the right thing right now, Colin.
Well, right now, I think for him, yeah, that's probably a good thing.
Yeah.
He's still giving himself a little bit of exposure to the equity markets, which is good because we are likely to see quite a rapid rebound here in the markets once the government sorts out everything and people have a clearer vision and understanding of what's going on.
20 years till retirement. So
20 years. So
hate to be the bearer of bad news.
Absolutely.
All right, let's go next to Mary. Hello, Mary.
Hi, how are you today?
Very good. What's your question?
I have a question. As a first-time buyer, I wanted to know if it would be a good time to go into commodities right now, like buying gold.
Okay, gold. Is that a good thing to go into as a first-time investor? First-time investor. She's wondering if she should go into commodities, like gold.
Commodities. Well, commodities, again, are very volatile, as is everything, it seems, these days.
As we see with oil.
Gold has always been a safe haven. And with a lot of uncertainty in the U.S. markets, I think that gold can be a very good place to hide, as they say. We saw yesterday when the markets fell 800 points, most of the gold stocks in the Toronto Stock Exchange were actually up. And that's just a prime example that shows that when things are in bad shape, everybody runs to quality, and gold has done very, very well and likely will continue to do well.
All right. Okay, let's go next to Greg. Hello, Greg.
Good afternoon.
Hi, what's your question?
Hi, I was just wondering, and I know it's an incredibly remote possibility, but if a Canadian bank was to fail, let's just say, and I have my investments through the investment arm of that particular bank, and so they put it in a fund that might contain any number of dozens of companies and whatnot, and exchange-traded funds or whatever, and that bank fails, what happens to my investment? Because the companies that are being invested in are still solid, it's just the go-between, the bank itself, has failed.
Okay, well, let's ask about protection for investors as a general question. Are these funds, mutual funds, or even your bank balances insured?
For the majority of them, absolutely. The bank accounts themselves. So if you just have a checking or savings account at all of our big banks, as he refers to, they're all protected under the Federal Depository for FDIC, Federal Deposit Insurance Corporation, and protects each account up to $100,000. So if a bank fails, this insurance that's out there will guarantee to protect that money.
And for investments?
Well, GICs tend to fall under that same umbrella. And then investments tend to fall under a different area. If you're with a brokerage firm or something like that, it's a similar type of thing. Again, it's another, it was Canadian Depository Insurance Corporation, CDIC, my mistake, I'm sorry. But there's a similar insurance for investments, and investment accounts are protected up to $100 million. Or sorry, up to $1 million.
Wow, I was gonna say,
Pardon me, up to $1 million.
Jeez,
My
okay.
mistake. Up to $1 million.
All right. Okay, Greg, hope that answers your question. Let's go next to Ryan. Hello, Ryan.
Hello.
Yeah, what's your question?
Well, I don't have a personal question.
Okay.
My question is about generally about the American bailout bill. I want to know, what are the chances that this is just an attempt to pump up the markets long enough for insider traders to pull their money out
The conspiracy.
and not lose anything?
All right.
Well, I can't really comment on that. I can say that the whole objective of this bailout is not to basically give everybody a mulligan, if you will, in golf terms, a do-over, if you will. This is really just to help support the markets long enough until they can sort out all the loans and all the bad loans. The big number that you see, the $700 billion bailout, that's not really what the cost to the U.S. government will be. That would suggest that every single house and every single piece of land that every house sits on is absolutely worthless. It has a value of zero. And it also suggests that every single person who has a mortgage is going to default on their mortgage and not going to pay it. The reality is that this may cost the federal government probably, I don't know.
I have to interrupt you. We have to check the daily phone poll. Here again was the question. Will you change your personal investments because of the U.S. economy? 155 said yes, but 287 said no. Well, we are all out of time. Our thanks again to Frank for coming in today. Thanks.